You are what you eat. Garbage in, garbage out. There's a long-standing notion that a thing is only as good as its inputs. And my guest today, David Trainer, says he can give you better inputs for investing. David, welcome.
Thank you, James. Good to be here.
David, your firm is called New Constructs. And to oversimplify, you basically make accounting numbers better. And the average person may not know the significance of that. But accounting numbers ostensibly represent the economics of a business. But you say they don't do that perfectly, and you can do a better job. Can you give a 30-second or 1-minute explanation of what you do and why it matters so much to investors?
Yeah, think about accounting numbers as sort of like a vocabulary of a language. They're really just good at counting different aspects of the business up. How you choose to arrange those numbers is really critical to understanding what matters most, which is sort of like the underlying economics, profits, cash flows of the business. And what's also really important is that you need a lot more vocabulary than what you typically get in a press release or an income statement. There are accounting numbers that are buried deep in corporate filings. They're known as footnotes, financial footnotes, notes to the financial statements. These items bury or hide a lot of very critical and important information that is substantive to understanding the overall larger economic picture. And so New Constructs, we created a technology to go and get that data at scale and put together better measures of earnings, better ratings on stocks, ultimately better stock picks.
And before we unpack this, because I love this topic, sell me on New Constructs. Like, can you give some performance numbers, some kind of outperformance, like quantify the benefit of what you do?
Yeah, sure. Like, first of all, we've got 3 indices with Bloomberg, a small family of indices that are based on our research and our data. One in particular is based on core earnings. That's outperforming for the year by 4% over the last 5 years. It's outperformed by like 40 or 50%. And these are live traded indices. Now, nobody can invest in
40 or 50%, meaning if S&P is up 10%, it's up 14 or 15%, or 40 or 50 percentage points?
40 or 50 percentage points.
Percentage points. Wow.
That's over the last 5 years. That's important that, I'm not selling anything here, that you can't invest in these indices. The only way to access this information is through our research. But these indices are live traded and demonstrate real live performance. We've also been the number 1 ranked stock picker on SumZero for 48 straight months. We've been a number 1 ranked stock picker in multiple categories over that time period. So we've got a pretty good track record, I think, just there in terms of stock picking. Hopefully that speaks for itself.
It does. It does. I'm thinking, David, just going back to 1992, there was a guy, Richard Sloan, who, Australian academic, for whatever reason, Australia, as a former penal colony, produces a lot of accounting researchers. Accounting is very like rules or following the rules oriented type of discipline. But anyway, he basically found that if you went long companies that had relatively high cash flows and relatively low accruals is sort of like, for the average person watching, if I buy a truck for $100,000 as a business, the cash went out the door then, but I get to pretend to pay for it in tiny little increments. Let's say $10,000 a year for 10 years, the usable life of the truck. So this ostensibly represents the better economics of a business, but he found that companies were abusing it. And basically, if you went long, companies that had high cash flow relative to accruals and shorted the opposite, you could beat the market by something like, I want to say 17 percentage points per year. You would think he'd be lauded, right? It took him like 5 years to get his paper published because, surprise, academics didn't like the idea that this system they had invented could be gamed so easily. And of course, now he's famous. Now he gets recognition. But like, that's what, when I first heard about him, that's what woke me up to the power of this. There has been, and I'll stop my monologue in a second, but there's been some dialogue among academics that these days you got so many analysts adjusting earnings into free cash flow, which is, if you're an analyst at a bank, at a hedge fund, at a mutual fund, you spend a lot of time, at least you used to, adjusting earnings into free cash flow. That's so like popular that it's no longer effective. You say that's wrong, it sounds like.
Well, I mean, the analysts it's been shown in studies, published studies, that the Wall Street analysts know that the companies are fudging the numbers and they don't do anything about it. Great article. It's easy to look up. Just look up CFOs fudge numbers. And
Great title.
Watch. And yeah, I mean, look, I was on Wall Street, and I was on Wall Street before the tech bubble, when I would say that people, I think analysts genuinely did try to do a good job back then. I think research mattered. But as the tech bubble took hold, good research got in the way of doing deals.
Hmm.
And I saw that firsthand. I mean, I was at Credit Suisse, which was the number one investment banking firm for tech IPOs. And I had meetings with analysts who said things to me like, accruals, balance sheet, don't bother me with that. I don't have time for that. I'm about to make $1 million on this IPO tomorrow. People are getting hired straight out of business school to make $1 million. Why are they hiring somebody straight out of business school? Well, because they don't know any better than to just pitch the IPOs. And then there's the famous situation that got Frank Quattrone, probably the greatest tech banker of all time, got him in trouble for a little while. He ended up getting it reversed. But, there are analysts at the firm who were publishing these glowing reports on the IPO in one breath, and the next breath saying to their friends, I can't believe anybody is stupid enough to invest in this piece of blank. So, look, people need to understand that Wall Street analysts don't make money producing good research. They don't make any money for the firm. All the profit comes from the investment bank and the traders. So if you don't serve the masters who make the money, you get fired. And I've got friends who got fired for that same reason. Mike Mayo, probably one of the best, if not the best, bank analyst over the last 30 years in terms of his calls on the industry and individual stocks, fired multiple times because he wouldn't play nice with the bankers. And you see him in the news all the time because he would ask hard questions at conferences of CEOs. And they're not used to that. I've gotten calls from CEOs before saying, hey, how can you publish a negative report on my company? How dare you? Do you know what you're doing? We're going to sue you. And I would say, look, I'm just looking at the numbers. And if you want to sue me, I'm just going to show up in court and I'm going to point to page 275 of the 10K and there's the number. And they go away. I'll never forget a situation where we were talking about GM's pension fund before the financial crisis and how underwater it was. And we were working on an article with Fortune magazine. And I remember the editor coming to me and saying, hey, GM's has a problem with these numbers you're showing. I'm like, well, show them the 10K. I'm not making this up. The number's there. And I remember getting a call. I was walking around Midtown Manhattan, getting a call from a couple of people in the finance department and the legal department from GM threatening to sue me for publishing these numbers. And I just said, guys, it's in your annual report. I'm not making anything up here. And
they're already published. Yeah.
It didn't get published. The folks at Fortune capitulated because why? GM spends a lot on advertising. And we all know what happened a few years later. The company went bankrupt pretty much because
Charlie Munger says, you show me the incentive, I'll show you the outcome. And that's so true in a lot of finance. And David, it sounds like you, just by the tone of your voice, not just the stories you're saying, you found that distasteful after a while and you went to start this business. In a nutshell, like, what's wrong with the numbers and how do you make them right? Like if someone's new to investing, relatively new to accounting, but is interested, how would you explain that to them?
Think about buying stocks as like going to a used car dealership. And you should expect the used car salesman, which is Wall Street in general, CNBC, all these folks out there, right? That's why they call Wall Street the sell side. They're selling you stuff. And what are they going to try to do? They want to sell it to you fast and for the highest price possible. Does that mean they're going to give you a tour of every part of the engine? No, they're going to talk to you about how shiny the outside of the car looks, how cool it looks, right? That's why we hear mostly about narratives, about how this stock is going to change the world, how it's the next Meta, how it's the next Amazon. That's what you're going to expect to see. If you really want to know what's going on, you have to basically train to be a mechanic, how to break these cars down, or find someone who knows how to do that. And at New Constructs, what we've done is create a technology that does that kind of work extremely well. We do a full overview or full breakdown of the car, every element of it, from the wheels to the carburetor, through the belts, through the transmission, through the alignment, the AC, everything. We're looking at everything related to the underlying financials of that business to help you have a real understanding on the health of that business. And then we reconcile that with the valuation. We look at what the valuation implies about how healthy that car has to be, or like how many miles it can possibly drive. And so we do that work. But if you're an investor, to put it in a nutshell, you understand what you're up against. They don't make money when you sell stock. CNBC doesn't make money when the market's unpopular. Wall Street doesn't make money when people don't buy IPOs and trade a lot. Think about how there have been entire industries, cottage industries, like these online brokers, like Robinhood, designed to do one thing, facilitate more trading, and then feed that trading data back to Wall Street so they can do what? Front run it. So I got to understand what you're up against, right? The system is very, very much built to take advantage of individual investors. We wrote that in the original IPO report on Robinhood about how effectively it was a cannibalistic structure.
You think they're front running, or they just want the dumb money order flow?
That's the same thing, right? I think they look at the dumb money order flow to get a sense of where the market is headed, right? Or to step in front of whatever trends are coming down the pike. Imagine if you woke up every day, James, and you had the order flow from all the major firms coming through your desk, and you built an algorithm to show that when the buy to sell ratio was over 2.175, what do? You buy in front of it all day long. When it shrinks to 1.2, you stop buying. When it gets to 0.9, you start selling. The point is, you know what's happening in the market, and you've got decades of history of this trading data that you can use to develop patterns to figure out how you want to trade. I mean, look, it's a no-brainer, right? I mean, they're all doing it. And that's why Robinhood gets paid hundreds of millions of dollars, because they're making billions of dollars.
Yeah, well, you don't have to convince me that the investing industry writ large, just globally, is not on the side of the investor for the most part. There are a few good eggs, but in general, it's a rent-seeking enterprise. You mentioned mechanic. I actually used to be a mechanic, a junior mechanic, when I was a kid. So let me get under the hood a little bit on your numbers. So if I ask you for 2 or 3 or 4 examples, let's say 2 or 3 of adjustments you make, like if someone says, "Okay, I get the idea, I want to make these numbers better," like what are some examples? What do you say?
Yeah, I think there's a Harvard Business School paper that was published in the Journal of Financial Economics, so a top tier peer reviewed journal. And by the way, it did take them years to publish. I have a similar history with Mr. Sloan here, because neither the accountants or the academics want to recognize that there are flaws in the existing systems because there's so much research based on them. But yeah, like let's just say that they're on page 275. We see that there's a write down on the obsolescence of inventory. That's an expense that you won't see on the income statement. It may be part of SG&A, it may be part of cost of goods sold, but it's an expense that's unusual, non-recurring, and depresses earnings. Right? And I'm not just talking about where companies use this to overstate. It can be used to find good stocks as well. That's how we use it a lot ourselves. To Richard Sloan's point, you want the companies that have good cash flows and low deferrals, right? You want companies that are more profitable than they seem. And that's an example of a charge. You get a similar situation where there's a reversal of an accrual for a restructuring charge. And sometimes those are even in tables. Well, where they will tell you that that reversal is divided up amongst SG&A, cost of goods sold, other. I mean, they'll give you a breakdown. These non-recurring, non-operating gains or charges, if you will, are split across these 3 items in the income statement. Sometimes you get that kind of detail. Then there's option liabilities, right? People think about the options that get issued in any given period, but how about all those outstanding options that are just sitting out there?
There's overhang, right? Yeah.
Correct.
I'm thinking in the 1980s, I remember watching Lifestyles of Rich and Famous, and the profile was this guy, John Paul Jones DeJoria, who used to be homeless in Hawaii and made Paul Mitchell hair products living out of his car with a partner, and then became a billionaire. His quote was, "Successful people do all those things unsuccessful people don't want to do." And this is kind of one of those examples. Like if I'm an everyday investor watching this, I think, oh my God, it sounds so complicated. I got to go in and sift through all these numbers, but like, that's why there's profit in this, because it's granular, because it takes a lot of background knowledge to understand the context, because it takes a lot of work. You got to read some fine print, but it pays off according to your numbers. How much are you leveraging technology, David? Because I know as a young hedge fund analyst, almost all of what I did was not like high level thinking at all. It was like mechanically looking at the paper, typing in, typing in. This is the old days before it was like automatically in spreadsheets. It seems like the bar has gone up, thankfully, in many respects. How are you using tech?
James, this is why we get along so well, because I spend a lot of time looking at stuff and putting it into spreadsheets. And so we use a lot of technology because that process, I mean, it's just not, you just can't do it that many times. You're not going to do it that many times. Nobody wants to do it that many times.
You're going to save your ammo.
Say again?
You got to save your ammo. If it's really that laborious, you can only do a few companies, really.
Yeah, I mean, it's so laborious. It takes so much time. Nobody really wants to do it. I mean, I saw this firsthand on Wall Street too, right? And I first got to Wall Street before the tech bubble. People could make a case for how important it was to do that kind of work. Like a lot of people did. Like you just got to do it. That's what junior analysts did. Now no one does that, and so it was important from inception for me at New Constructs to create a technology that would make it easier for the expert analysts that I was creating to go and collect that data. And that was really kind of our original technology, James. It was really pretty simple. It was an application that integrated the filing, the database, and some parsing tools. And those parsing tools had some intelligence, like balance sheets have to balance, and the net income should add up to all the constituents in the income statement if you properly categorize the income and the expenses. And option tables have ways of summing up. Operating list tables have ways of summing up. And so we built all these sort of very simple tools in the beginning and started collecting data, but the machine would track everything that these experts were doing. By the way, though, they could go through an entire filing in a couple of minutes, where it would take, if you're doing it manually and typing the data in, as you said, it would take, gosh, I mean, at least an hour, even if you were an expert, to go through an entire filing and you already had a model built and knew what everything was to go. But for most people, it probably takes 8 hours, right? It's the average novel is around 200 pages, and they say it takes 8 hours for someone to read that.
Yeah, yeah, and you're going to have human error, model risk, basically too.
Yes, that's a big part of it too. Everything going into a system and a machine can also be error checked. It also removes the possibility for fat fingering, which, as you know, when you're doing it manually, happens all the time. Like even I fat finger, like even I'm typing stuff in. So everything would automatically copy pasted or grabbed and put into a database. And so technology from inception was absolutely critical to doing what we're doing, because to your point before, right, there's profit in this because we're doing the things that nobody else wants to do. But there's also a great deal of expertise in how we actually do these laborious things. And the opportunity for real value creation is in scaling the process. So we can take this expertise, train it through this very laborious process so that our AI is smart enough to do the things that an expert would do, but experts are unwilling to do it at scale. Well, then we got something special. And that's what I think is special about New Constructs, and which is why we are able to show this tremendous outperformance in live markets in our stock picking track record, because we're getting the data that no one else has, and that data generates idiosyncratic alpha.
So let me double click on that. It sounds like, and correct me, David, if I'm oversimplifying, the secret sauce is in distilling the numbers correctly. There's not so much a black magic to what you do with them. There's no arcane formula. There's no black box model. You're basically running tried and true. I know on your website you talk about return on invested capital analysis, which is my favorite metric, frankly, because it's the raison d'etre of a business, right? You're supposed to out earn what your capital providers expect. It is a little laborious. It's not like ROE, which you can just pretty easily do. It takes a little bit more legwork, not a ton. But anyway, it sounds like the secret sauce is in the numbers. You can go with those numbers then to the tried and true, whether it's a DCF model or where it's ROIC or WACC, economic value added, something like that. Is that accurate?
It is accurate. It's absolutely accurate. There's no, and I don't believe in general in AI, for that matter, that there's any magic bullet super algorithm that goes and figures this stuff out. And I think what we're seeing now in sort of the post hoopla around ChatGPT is that, wow, we can't really trust this stuff. And to your point at the beginning of this discussion, James, the output is only as good as the inputs. And what we've created is a superior set of inputs. It just so happens that those inputs are particularly difficult to get. They're particularly difficult to understand. And so you've got to have expertise. You've got to have special tools to go get them. Then you have to have technology to do that at scale. If you can do that, well, then we're doing the things that nobody else wants to do, but there's profit in that. There's value in that. So yes, exactly.
So why isn't everybody using this? Like, why don't all the banks, all the hedge funds buy your data and use it up to the point that there's no longer exploitable alpha?
Well, there are some. We've got some really big name clients. I'm not always allowed to say who they are, but we got some of the top quant funds in the world that are clients of ours, and we've got a lot of other clients. We haven't taken over the world yet because, let's face it, we're competing with Wall Street. Does Wall Street want what we have to be available at large? Right? How hard is it going to be to sell IPOs like Beyond Meat or Carvana or Robinhood when you really look at the numbers and you see that in order to justify its IPO price, that Robinhood's going to have like 50% of Schwab's market share in the next 5 years? Maybe that's impossible. And look, we a great example of how our work can take down an IPO is with WeWork. And when we did our pre-IPO on WeWork, that was in a different era, James. It was in an era when the S1, which is the filing required for IPOs to submit to the SEC that shows all the financials, that era, S1s would come out at least 6 weeks before the IPO. So when the S1 for WeWork came out, we wrote a report saying this is the most ridiculous IPO of 2019. I don't remember the day. It was a few years ago. We were like, this is ridiculous. And we wrote down all the reasons it was ridiculous. And, they went from asking for, I think, I don't know, 40 or $50 billion valuation to within a few short weeks, SoftBank pulling the IPO and writing the value of the company down to $4 billion in their own books. So
I think it was a $60 billion ask initially, actually, even more than that. Yep.
Okay.
So you were very, very right, basically. If somebody was just not paying attention to investing then, like WeWork was one of the biggest bombs, like biggest value destructions in recent history, essentially.
Yes. And it is an excellent example as to why Wall Street can't or doesn't want to accept what New Constructs does. Because New Constructs takes an IPO like WeWork and blows it out of the water. Now, we've written several other pre-IPO reports and been very right. Shopify, Beyond Meat, Peloton. And we did the same analysis. But you know what happened in those situations? There was like 2 weeks in between the S1 and the IPO. Sometimes it's just a matter of days. So, our message doesn't have a lot of time to get out there. And we're also competing with a much bigger distribution platform with respect to message. And so we are not in the best interest of the majority of Wall Street because the truth we tell would discourage a lot of the unsuspecting investors that Wall Street is targeting to exploit.
For the most part, Wall Street is an intermediary. It's not a fiduciary on the investor's behalf. They basically are ambivalent about what the thing is. They just want throughput. They want to sell it to you. I don't think they're all bad guys. I think Wall Street sometimes gets maligned, but a lot of that is fair. Not all of it is fair, maybe, but a lot of it is fair. There are some good guys. So David, let me segue though. If someone says, "All right, cool. How do we take a test drive? Can you explain a little bit more about how do you feel about investing right now in the U.S.? We got a very volatile political climate. Valuations are still fairly high writ large. What's your broad feeling first, and then maybe a couple of names that you're looking at that look good in your model?
Yeah, everything you said is true, James. My first comment is be careful. Be careful. Don't buy everything they're telling you to buy. Don't buy the headlines. Don't buy the narratives. Do your diligence. And when we do our diligence, we find some great stocks. In particular, Pilgrim's Pride. It's a stock that we think is
the chicken producer.
And one of the big things that people don't realize is like red meat prices are going through the roof, and it's only going to get worse because they have a large scale cyclical decline in the overall herd. This happens once every 10 or 25 years. But at the end of the day, the things we love about Pilgrim Pride are very profitable, great margins, great capital efficiency, great return on invested capital, and a cheap valuation implying profits are going to permanently decline. So we like stocks when the valuation implies profits are going to permanently decline. And what we sort of tend to move away from are stocks where the valuations imply they're going to have market share greater than the entire market. Tesla's a great example. That stock price has implied over the years that the company would own more than 100% of the entire electric vehicle market. Now it's around 50 or 60%, still absurd numbers.
Yeah. Now, presumably, in their defense, they're baking in some optionality, or at least the rational ones would say that maybe Tesla's going to go into other things. And there's certainly companies like Apple, right? Apple used to be a computer company. If you valued it just based on computer market share, it would be a lot smaller. But guess what? They got into iPods and then iPads and iPhones and and now whatever else, right? But I get your point. Trees don't grow to the sky.
That's right. And we handicap the Tesla revenue to assume that some of these other businesses will be successful, right? And that just means it's only a portion of the revenue to go to automobiles. But yeah, so that Pilgrim's Pride is one. Another one we just pulled out recently surprised me. I remember the team first brought it to me. I was like, no, come on. This is going to be a slow grower. This is a boring, nobody wants this. Crocs.
Huh.
It's actually got a really good marketing strategy. They're all over TikTok. They're growing and they're cheap too. And they're super profitable. And so look, the takeaway is if you do this work that we've been talking about, James, where you go sort of the extra mile, you do the things that other people don't want to do, you can find real value. It takes discipline though. You can't fall for the eye candy, for the sexy narratives from Wall Street about all these other stocks that are just going up, up, up. I think those are really dangerous. I highly recommend avoiding those and focusing more on stocks where you can trust that the profits are real and that the valuations are cheap or reasonable.
I like it. In the past 10, 12 years, value has certainly taken a distant backseat to growth. And you could make an argument that as humanity evolves, there's this parabolic improvement. Someone from 3,000 years ago would probably recognize the life lived by someone from 2,000 years ago, but someone from 200 years ago would barely recognize the life today, right? Or more cancer progress has been made in the past 10 years and arguably in the past 100, right? There is probably a parabola to an extent, but overall, human psychology predisposes us to overpriced growth companies. I know you like academic studies, David. 1994, Lakana, Schliefer, and Vishny found that growth basically loses to value over the long run. There's a number of studies. Even though that's not been true over the past 10 years, it has been true over the past 80 years, something like that. I'm extrapolating. So long story short, I'm endorsing the way you're looking at stocks. If someone was watching this, say, this sounds cool, I want to check out Pilgrim's Pride, I want to check out Crocs, and I want to be cautious because I agree with David. We're in a crazy volatile era, but I want more of David. Where would you send that person on the internet?
Go to our website. I will share the screen here in just a second and give you a chance to take a look. If that's okay with you, James.
New Constructs. Yeah, we'll put it on the screen underneath in the show notes as well, but please share it on the screen if you'd like.
Yeah. But yeah, here's the website, newconstructs.com. Very simple. And if you're interested in getting access, just click here. We've got all kinds of memberships.
Okay.
The blog here, there's a lot of free research. In particular, we've done a lot of great work here on dividends recently. I think dividends are get a little bit of a free pass. People think dividend stocks are an easy, straightforward, slam dunk safe haven. That's not the case.
And so you get these dividend impostors or all kinds of wannabe dividend companies that kind of shouldn't be dividend companies too.
That's right. Yeah. And one of my favorite dividend traps is sort of the false dividend stocks because they actually don't generate the cash flow required to pay the dividends. I think we got a couple of good examples here. You can see this is the difference between the cash flow and the dividends paid.
Ouch.
I think for these guys, the dividends exceeded the free cash flow by $579 million.
Ouch. Yeah, I'm putting my glasses on to see this. That should be a big red flag. And I'm glad you used the color red for that because it's just amazing how people might buy this off of a screen or buy this with no research. Maybe some ETFs have to buy it because they're structurally mandated to buy dividend stocks with yielding a certain percent. It's just a shame. These people are, I don't know this company yet, but there are people out there trying to game the system. And this could be one of them.
100%. We got three examples. And in our system, I think we found, 344 false dividend stocks overall. That's the benefit of covering as many companies as we cover. We're giving you basically the truth about the entire stock market in the U.S. And then we've got model portfolios that people can buy to avoid this stuff. And this is the idea. Like, hey, listen, those are dangerous dividends. Here's a safe dividend yields model portfolio. And here's a report on the fake dividend stocks, which is bad businesses that overprice where the stock is overpriced. So you've got both the risk of the dividend kind of having to be reduced and then also the stock price going down just because it's a bad business and it's overpriced.
That sounds doubly bad.
Yeah, we got
Yeah.
live training sessions on all this stuff too. So people want to learn more. These are free, and so that's a great way to get to know new constructs in a very short amount of time.
Sounds good, David. This has been very informative. I always like to geek out on accounting stuff, and maybe one day we can go even deeper, make like a special session where you could really get into the granularity, because this stuff is really fun to me. Again, there's a learning curve. It's kind of like playing, I don't know, a flight simulator video game, and I haven't played video games in 30 years, but you got to read the manual first. It's not like a driving game where you just jump in, right? There is a bit of a learning curve, but you want that. You want that because that's why there's a barrier. That's why the returns are ostensibly a bit higher to those willing to make the effort. So, David, you are one who makes the effort and you make your work accessible to other people. Thank you for sharing your thoughts, your insights with us today. And thanks to you guys for watching us at home.
Thank you.